Since the 2008 global financial crisis, government central banks have been net buyers of gold bullion for their official gold reserves, adding close to an admitted 6,000 metric tons, currently valued at $370 billion. Major central banks like Germany and Poland have also repatriated or demanded back physical delivery of much of their official gold bullion reserves they once held at places like the Federal Reserve in New York or with the Bank of England in the City of London. The amount of gold bullion central banks have been buying collectively in terms of overall metric tonnage on a historical basis have been hitting record high levels of late. The first half of this year, 2023, was no exception to this trend, which ramped to historic high levels last year in 2022. Just under 400 metric tons were purchased for the first half of this year, led by China, Singapore, Poland, and 6 other central banks respectively. Last month, China also made another official gold bullion addition of 23 tons, having now added 188 tons of gold bullion in the last 9 months of consecutive bullion buying. This central bank gold bullion buying spree has been happening while unsecured gold ETF shareholders have been net sellers. Likely much of that gold has gone to central bank coffers. The same time frame over the last year plus, unsecured silver ETF sell-offs have also subsided. Much of that silver that was sold off in early 2022 likely was shipped off to places like India, China, and has gone into private silver bullion stashes in the Western world. Natural resource investors Goring and Rosenzweig pointed out that central bank gold bullion buying has been so strong that it's altered the trading patterns of silver and gold traders. Given the lack of any central bank silver buying, net selling pressure in response to raising rates has become far more intense with silver than with gold, where these central banks are buying in gold, obviously. The added selling pressure has turned the silver speculators even more bearish. By comparison, gold net selling pressure has been much milder. Central bank buying absorbed most speculative selling in global gold market. To further drive their point home about silver speculators becoming bearish in the COMEX silver futures market, today, the Commitment of Traders report illustrated that large bank swap dealers are now net long silver, while speculative managed money hedge fund crowd is now net short silver. Now, for those who consistently monitor the COMEX COT reports, this uncommon situation is often perceived as a bullish signal. Currently, the respective gold and silver fiat US dollar prices are both hovering right near their 200-day moving averages. In a bullion bull market, buying near the 200-day moving average typically proves prudent in time.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce Silver Eagle coin giveaway.
Want to win 500 Silver Eagle coins just like this guy?
Yeah, this is Kevin.
Hi, Kevin. This is Dr. Tyler Wall, CEO of SD Bullion. I'm calling to let you know that you won the SD Bullion giveaway of a monster box of 2022 Silver Eagles.
Unbelievable. That is awesome.
So click the link below for your chance to win.
Good luck to all of you out there who enter our free 500-ounce American Silver Eagle coin giveaway sweepstakes.
Spot silver and gold prices both sold off for the week, with the silver spot price falling below 23 an ounce to close. The spot gold price finished at $1,913 an ounce bid, while the spot gold silver ratio climbed to 84. In industry news, premiums on bullion products continue to fall, with deeper inventory levels at the moment. Outflows from the U.S. bank system have mostly stabilized, but an interesting twist has occurred this summer, as there have been more net outflows from big commercial banks and some inflows into smaller regional banks who are often offering better interest rates on savings accounts. Of course, given where long-term U.S. bond yields have recently spiked to, and the lack of coming to terms with commercial real estate losses yet to be fully admitted, we still don't know how many U.S. banks will eventually prove insolvent. Cash also has been fleeing to money market funds, but given how they performed during 2008 and 2020 respectively, considering such funds a safe haven might again prove to be wrong under heavy future redemptions. It's of course understandable so much capital has been trying to flee the US bank system for safer havens, but consider Gallup's polls now versus the last time gold went to a mania phase in the late 1970s. Collapsing confidence in U.S. banks is now nearing lows not seen since the 2008 financial crisis fallout. In other words, it's not going to take much in terms of further bad headlines to see more withdrawal pressure on many fragile bank balance sheets and another round of heavy inflows into the physical bullion buying industry. This week, the head of the Fiat Federal Reserve was in Washington getting grilled about why the arbitrary 2% price inflation target is seemingly something picked out of a hat. The internet mocked Jerome Powell's response appropriately.
For the general public, for those working families and people, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another. How
does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not, it's not obvious how that is, but 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because the evidence is and the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. If everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So
the one thing we can all expect is that the fiat financial authorities will continue insulting our collective intelligence in the face of higher year-on-year price escalations as time continues onwards. The fact that many of the central banks continue to openly buy gold bullion in record size confirms they don't have much faith in current fiat currency store of value cases either. That's going to be all for this week's SD Bullion Market Update. Take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.